Whenever we talk about investing, it is absolutely crucial to have always a clear strategy. And today I would like to dive into some essential concepts that every wise investor should know. We will explore together why it is absolutely paramount to study a company before deciding to invest in its stocks, or to say it better, to value a company before buying its stocks. Breaking down, first of all, two of my favorite ratios, the price to earning and the price to book, as well as discussing a powerful strategy called pair trading that allow every investor to increase massively his chances of winning. That is not bad. And now subscribe to the channel and let's get into it. Number one, why it is so important to value a company before investing. Value a company before investing is like looking at the price tag before making a big purchase, because you want to know if you are getting a good deal, right? Understanding a company intrinsic value helps you avoiding overpaying for stocks that may be overpriced or missing out on opportunities whenever stocks are undervalued. This kind of evaluation gives you insights about the company financial health, growth potential, and risk balance, assuring that your investment aligns with your risk tolerance and, most importantly, your financial goals. But now let's go a bit into the nitty-gritty details. Price earning ratio. The most famous among all financial ratio is the price to earning, also called PE. That is a key metric that shows the relationship between the price and the earning per share. In substance, it gives you an idea about how much investors are willing to pay for each dollar of earnings. To calculate the PE is super simple. You just need to take the current stock price and divide it by the earning per share. Alternatively, you can take the total market cap of a company and divide it by the total net profit of the company. Now, just to make a quick example, if a company stock price is $100 and its EPS, earning per share, is $5, it means that the price earning ratio stands to 20, or to be precise, 20 times. But what does it mean in tangible terms? Well, we have two options, either to follow the bull case or the bear case. If the price earning is particularly high, we can say that the hype around the specific company is quite tangible, meaning that investors expect strong future growth for that specific company. The company could grow within the valuation. We have also to take into consideration, however, that an excessive valuation in terms of price earning, we could have come across a company that is overvalued. Long story short, a company that will not manage to satisfy the unrealizable expectation of the investors. And this is not a good thing. Moving on, if on the other hand the price earning is particularly low, it could be a signal that the specific company is undervalued, signaling that the prospects according to the investor base are not promising. However, as Warren Buffett used to say, sometimes stocks trade at silly prices, and here is the perfect timing for savvy investor to jump in and buy a discount. Because remember, you have to be fearful when others are greedy and greedy when others are fearful. Ratio number 2, price to book, that compares a company market value to the book value of the same enterprise. That is essentially the value of its assets minus the value of all liabilities. Calculating it is again super easy. Take the market cap and divide it by the shareholders' equity. You can find the shareholders' equity in the balance sheet within the financial reporting. Alternatively, you can take the price per share and divide it by the book value per share. All this information is commonly reported by public data providers. Easy peasy. Just to make an example, if the price is $50 and the book value per share is 25, it means that the price to book is 2 times. If the ratio stands below 1, it will be a signal that the company is undervalued. Anyway, a ratio above 1 is not necessarily a bad thing, because it varies industry by industry. And for instance, tech stocks trade at really high price to book values compared to more traditional sectors such as industrial, automotive, utilities, and so on. So before taking any investment decision, it's always recommended to check also the performance of the peers. Long story short, knowing what is the price to book helps you understanding whether the market is under or overvaluating a company. And now, having introduced two of the most important ratios and the concept of peer group, we can move to the step number 3, that is a strategy called pair trade. Let's start saying that pair trading is market neutral, since it does not depend whether the market is going up or down. That is a big advantage for those people that are stressed about the market behavior, or the so-called mood swings of Mr. Market. But how does it work? It's very, very simple. Pay attention because I'm gonna tell you a nice trick. In a pair trade, you buy a stock, but at the same time, you short another. That is closely correlated, and this is important. It is easier to find strictly correlated companies within the same sector. And here we go back to the concept of peer group that we introduced before. For example, if one company seems undervalued compared to another, you go long on that stock, meaning that you place a positive investment on this one, and short an overvalued one. As their prices will tend to converge, because they come from the same sector, you profit only on the difference. Just to make it simple, you carve out the market volatility because you bet on the better performance of a company compared to another, making your investment totally immune to any market swing. Just to conclude, pair trading is a low-risk strategy because it focuses on the price relationship between the two stocks rather than the market. And the cool thing is that it is extremely effective during volatile market conditions. So guys, here you have it. 3 critical concepts to elevate your investing game to the next level. Understanding the price earning, the price to book, and what is a pair trade will help you making smarter and more informed decisions. Now, before saying goodbye, if you found this video helpful, be sure you hit that like button, subscribe to Beyond Alpha, and ring the bell, so you never miss an update. See you in the next one. Cheers!
But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now the big mistake which we made in the early years was to try and buy a bad business at a really cheap price. And it took me about 20 or 30 years to figure out that wasn't a good idea.